Hey, Finance fam, welcome back to my channel. There are banks crumbling all around us, so I brought the brightest mind I could find in finance to help us figure out what the heck's going on. Hello, Travis. Thank you for being here.
Yeah, great to be here. What a week, huh?
We really need you right now to really break this down and explain like I'm five. WTF is going on with these banks? So first of all, Trav, maybe let everybody know you're Stock Geek TV. Some people may know you as Stock Geek TV, but maybe let the audience know who you are, what you do, why you're qualified to talk about this.
Yeah, absolutely. So I'm Travis, aka the Stock Geek, and my handles on Twitter and YouTube are StockGeekTV. But I come from a professional investing background. So I majored in finance and I worked for hedge funds right out of school, working as an investment analyst and as a portfolio manager for the better part of the decade that encompassed the financial crisis. So we had a lot of experience investing in distressed banks during 2008 and 2009. A very stressful, but a very good period to learn about financial stress in markets and how to navigate it.
So you know what you've been here before, but on like a much more intense level than I would say.
Yeah, I mean, it's certainly getting intense out there right now. But
Okay.
yeah, 2008, 2009, it felt like, I think 2008 felt like just an eternity of time where you could wake up on any day and a financial institution was failing or stocks were crashing, or on the flip side, stocks were mooning because people all of a sudden became optimistic again. So it was just this lengthy period. We've had quite a short but volatile period here in the market over the past week or so as people have become worried about the banking system. But 2008 was like an extended period of months and months and months of that. So certainly, I think the intensity and the length of it was certainly. I hope that we don't get into that this time around. I hope it doesn't extend to that type of a period. But like I said, it was looking back on it, I think it was some of the most formative times of my career. We had the best year ever at our hedge fund in 2009, believe it or not. And so that really came about because of the work and a lot of the hours that we put in during 2008.
Yeah, so that's why you're here today to help us figure out what is going on and how can the everyday investor unpack all of this to decide, okay, is this going to affect me or not? How should I be thinking about this from an investing perspective and so on and so forth. So I was hoping that you could give us a quick, like, explain like I'm five. Why are banks failing around us? What are the banks that are failing? And basically, like, what caused this?
Yeah. So what's happening is almost as old as time. The commonality between the banks that have already failed, looking at Silvergate, Silicon Valley Bank, and Signature Bank, the commonality is that they had a good old fashioned bank run. So depositors leaving the bank in mass in a very short period of time, which then causes the bank to have to sell assets, which they don't want to sell or they can't sell, or causes them to incur losses when they sell them. And that, of course, leaves the bank insolvent. And so all of that essentially means that the bank has to be taken over once they get to a point where they don't have the liquidity to meet the depositor outflows. And you have the FDIC step in and other regulators step in to try to make sure that the pain doesn't get worse and that depositors have their funds at least somewhat safe. So the commonality really is the catalyst. Now, there are some significant differences between these banks that have failed. We could definitely talk about that too. Their assets that they hold slightly different from bank to bank, but the commonality here is really that good old fashioned bank run.
So, like, why did people rush to these banks to pull their money out? That's my question.
Yeah. Well, in the case of Silvergate, they had significant relationships with the crypto ecosystem. And after some of the high profile frauds and failures there over the past year, a lot of people in that ecosystem began to worry about counterparty risk. So they started to pull their funds. And once Silvergate became on the list of troubled institutions, most of the major crypto players, including crypto exchanges and others, actually pulled their funds. And so that was a big cause in the case of Silvergate. In the case of Silicon Valley Bank, it's actually kind of amazing what happened. The VC community, the startup community, Twitter, everyone else, basically social media in general, created a panic about Silicon Valley Bank on Thursday. Now, Silicon Valley Bank, to their credit, they were trying to raise capital because they saw themselves as having some solvency issues. And so the bank actually was trying to raise capital. But that morning when they announced the deal wasn't completed. and the market punished the shares. And once people saw that the shares were down so much, they began to panic. And so again, that's when social media took hold. A lot of
Mhm.
venture capitalists, a lot of the people with big voices out there started saying, pull your funds out. In fact, I know a lot of angel investors and startup founders myself through my angel investing. And we were talking in groups about whether or not people should actually look to pull their funds from Silicon Valley Bank. And so, yeah, that was really what happened there was a spook. Now, Silicon Valley Bank had also been slowly bleeding down deposits over the past few quarters because a lot of the tech companies that do banking at Silicon Valley, they had massive inflows of deposits when they were getting funded in 2021 and 2022. But a lot of those companies are burning cash. They're unprofitable. And
Mhm.
so Silicon Valley Bank was already seeing a slow decline in deposits. Thursday was really just the big day when I think over $40 billion worth of capital was pulled out in one day, a new record. Washington Mutual, which failed in 2008 and was actually a bigger bank in terms of total assets, I believe, it had only seen something like 18 billion of deposit outflows over a 10-day period. So you can see that the age of social media has really sped things up.
Yeah, and I did see that there's now talk about regulating social media so that this doesn't happen again. These bank runs, people can't spook others and say, "Oh my gosh, you need to." Actually saw this on social recently. There was a financial influencer that was basically saying you need to pull your money out of Wells Fargo, or there was SoFi was another one that they were talking about. So it's like these big influencers can impact these people, and they may run to the bank and pull their money out of fear without really understanding what's going on behind the hood of the bank. And I think that that's where, I kind of want to cover some of that today, because it might help some people figure out maybe what they should do, or if maybe they should do nothing. Is their money safe or not safe? And that's where, you come in and you look behind the hood at the actual financial statements of these banks, and you
Mm-hmm.
can read it for yourself to say, oh, this is a little bit this is a little bit risky, or this bank is very capitalized and they're going to be fine. So that's a skill set that I really wanted to bring to my audience, because you're so good at it. So
Thank you.
we know, no problem. So we know that basically this was part of this was social media fueled.
Mm-hmm.
We know that banks don't actually, when you deposit a bunch of money at a bank, they don't actually keep all that money in your account for you. That's why it's called fractional reserve banking, right? And that a lot of people may not understand how banking works. So I just kind of want to do a quick run through of that, and correct me if I'm wrong here, but basically the banks are taking your deposits and they're doing other things with it. They're lending it out, or they're investing it in other assets, correct?
That's right. Yeah. The basic mechanics of a bank, as you mentioned, are to take in deposits and then use those deposits to either make loans or invest in securities to try to earn a higher return than they're paying you for your account. And that's the spread that banks earn that makes them usually, in most environments, very, very profitable.
Right. But the problem here with, particularly, I guess let's start with Silicon Valley Bank. It looked like they invested in a lot of long dated bonds that had very long out maturities. So for anybody
Mhm.
that doesn't understand what that means, when you buy a bond, basically it has a time period where you have to wait to get paid back the money you invested plus interest, right? You get interest along the way, but you have to wait a certain amount of months, years to get your actual investment money principal back. And so the longer you have to wait to get your money back, that's usually beneficial to the investor because they get higher interest, correct? But unfortunately, the Federal Reserve raised interest rates very fast. And my question to you, Travis, because when the Fed did this and they raised interest rates so fast, that basically changed the value of the assets that these banks had on their balance sheets. Do you think the Fed knew what they were doing and knew that something like this was going to happen when they raised rates so fast with banks that had assets that were going to basically decline in value because of their actions? Do you think the Fed was aware of the potential for this to happen, or do you think that they were blindsided by all of this?
I think they were aware that there were risks out there in the system that, they would see pop up once they did raise rates this quickly. I don't think they had a lot of choice because with the tools they have trying to fight inflation, rates are really the most significant. Now, did they intend to create failed banks or run on the banking system? Absolutely not. That's, the Fed's worst nightmare. They don't want to be working all hours during the weekends and trying to stave off, financial crisis. Certainly, I don't think that they intended that. But yeah, I do think that they probably knew that there could be some pockets of the markets or pockets of banking where there would be significant things that happen because of the rate rises. And this was the fastest rate hike cycle from the Fed in the last 50 years. So maybe ever, I believe. We'll have to double check this data, but I certainly in the
Yeah.
last 50 years, the fastest hike cycle.
Yeah. So something was eventually going to break, and it kind of did break essentially. But okay, so what I wanted to ask was, I know that you've put out a lot of great tweets on this whole situation and on all of the different banks that we've kind of seen go through crisis. So I wanted to pull this tweet up because there were, three main banks that you were looking at, correct?
Mm-hmm.
And
Yeah.
yeah, go ahead and talk about this and what we can kind of point out to viewers so that they can kind of understand this a little bit better.
Yeah, my intention this week has been to look at some of the other banks that are still trading publicly that are still open for business and taking a look to see if they are facing the type of situation Silicon Valley Bank did. Because the reality is, if you look at Silicon Valley Bank's balance sheet, it's very clear what happened, and it's very clear that you could see they had a solvency issue. It's very clear that there were serious problems that if you had just taken a cursory glance, that you would have understood what happened and why the bank failed so quickly. Happy to talk about that as well.
Yeah.
And
I
Silvergate, the same thing, really. Silvergate, I'd actually done a podcast episode on January 17th on my podcast saying, this looks really scary looking at their balance sheet. I think people should stay away from Silvergate. So
I pulled up Silicon Valley's balance sheet so we can kind of take a look and you can walk us through the things that maybe will help people understand this a bit better. Because yes, you called the Silvergate thing like really well.
yeah,
And you did that by just taking a look, right? So, this is the balance sheet. What should we look at? What can you kind of help us understand better about this bank failure?
Yeah, so I'll give you the very high level of bank balance sheets to kind of start with. A bank is going to take in your deposits. That's a liability for the bank. It's an asset for you to have deposits, but it's a liability for the bank. So on the liability side of a bank balance sheet, you typically see deposits. Sometimes you'll also see debt and equity as well. And then on the asset side, for banks, the assets are the loans and securities that they take your deposits and invest in to try to earn a higher return. So if you look at Silicon Valley Bank's balance sheet, we'll start at the top, I guess, with assets. If you look, they have some cash. They have about 13.8 billion of cash. Then they have what's called available for sale securities. Those are mostly short-term government bonds and bills that trade basically around 100 cents on the dollar. They had 26 billion of those on the balance sheet as of year end 2022.
So if
Next,
somebody came, sorry, Trav, but I want to
yeah,
point this out. If somebody came to the bank and was like, they were trying to pull their money out, the bank would go here first, right?
that's right.
They'd go to sell their available for sale securities first.
Yeah, cash and available for sale securities is going to be the first place the bank is going to go to try to meet deposit outflows. That's right.
Okay, that leads us to the big bad held to maturity securities that are the big problem here. Go ahead.
Yeah, and so the held to maturity securities is the next big bucket, and for Silicon Valley Bank, you can see how large that is. It was 91 billion that they had it marked at the value on their balance sheet as of the end of the year. But along that line, you can see something interesting there. Held to maturity securities at amortized cost and net of allowance for credit losses, blah, 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 blah. But it says fair value of 76 billion and 97 billion respectively. Respectively means basically for those 2 years we're looking at here on the balance sheet. The 76 billion is the end of 2022 figure. So even though the line there says 91.3 billion of held to maturity securities, 76 billion is the actual fair value. If they had to sell those securities today in the market, 76 billion is the amount that they would get for them. So there's a big gap there between the 91 billion that it has as the actual balance sheet value and the 76 billion of fair value or market value. And you mentioned it earlier. Basically, what happened here is Silicon Valley Bank was attracting a ton of deposits as startups were booming and raising a lot of funds in 2021 and early 2022. And so they had all this money and they didn't really have enough places to go put it. They didn't have enough business loans to make. They didn't have enough other things to invest it in. And they thought, well, for the time being, we'll invest it in safe government securities that are 5-10 year bonds. And eventually we're only going to earn 1.5% of interest, but these are super safe and we won't have any issues with any defaults on these government securities. So that's why they did it.
Mhm.
Now, should they have foreseen that rates were going to rise? We can talk about that. Should they have put on some interest rate hedges? Probably. But the reality is, at the end of 2022, all those securities that they bought in 2021 and early 2022 had gone down in value. So they weren't worth 91 billion unless they held them all the way to maturity. They were, if they had to sell them today in the market, only worth 76 billion. So there's a $15 billion gap there between the value that they have them on their balance sheet value versus what they were worth in the market. And
That's a
and
lot
so
of billions.
yes, exactly.
Yeah.
And so you can see then also on the balance sheet on the asset side, there's also a pretty big amount there for loans. I mean, total investment securities, if you add up the held to maturity securities and the available for sale, 120 billion. But again,
Mhm.
remember 15 billion of that should be marked down if they had to sell them at market value. Then
Right.
there's also 73 billion of net loans, just a couple of lines down there
Yep.
below.
See that here?
If you add the loans and securities, that makes up most of their total assets. So their total assets, 211.79 billion there. But securities and loans make up the most of it. And securities themselves are the biggest category of loans, right? So the key problem there, if you're looking at the asset side of Silicon Valley Bank's balance sheet, is that they have all these securities. If they had to sell them today, they would be worth $15 billion less than they're actually marked at on the balance sheet value. What does that mean? Well, if you go all the way down to the bottom of the bank's balance sheet, you see what's called total equity. This is one of the most important figures for a bank. It's basically how much shareholder capital has been put up to actually create this bank and sustain this bank. How much shareholder capital, how much of the stockholders' money is put up at risk to operate this bank on a day-to-day basis. And you can see that total equity value is 16.29 billion.
That's very close to 15 billion.
That's right. So if they were forced to sell all of their held to maturity securities at the market value, they would take a $15 billion loss. That loss would come out of the equity value. That's the first place that losses are taken for a bank. They're taken out of equity value. And that equity value would essentially go from 16.2 billion to almost zero. It would go to like 1.2 billion, I guess, after the $15 billion loss. That would wipe out most of their equity. That's
Well,
super important because banks are required to keep a certain amount of equity to total assets.
and that's why the stock tanked,
Mm-hmm.
because that equity basically went to almost zero,
Yep.
assuming that they, sold for the assets for a loss.
Yeah.
And that's why the stock reacted the way it did.
Yep. And it's like we said earlier, when you have deposits flow out as a bank, you are forced to sell some assets to raise capital beyond a certain point, right? If you exhaust all the cash that you have on your balance sheet and you exhaust all of the short-term securities you were able to sell and deposits are still flowing out, well, then you're going to be forced to sell some of those long-term securities at a loss. And that's going to essentially force that equity value to go down. And then you have more people worried about you, and that just feeds on itself and you have more and more depositors leave. So that's
That
essentially
makes
what
sense.
happened.
Yeah. Okay. So let's talk about a different example. That was an amazing overview. And I think that will make a lot of sense to a lot of people, especially seeing you talk through that balance sheet. But let's take a quick look at a different bank that has concerns for kind of a different reason. Is that
Hmm.
is that true?
That's right. Yeah. Similar but different. So First Republic Bank services high net worth clients, kind of similar to Silicon Valley Bank. They don't have as many corporate customers or venture capital customers, but they serve a pretty high net worth base. A lot of their deposits are uninsured. By the way, this is something I should have mentioned earlier. When you look at a bank's deposit base, one of the things that makes a deposit base more risky or more likely for depositors to take money out is if those deposits are above the FDI insurance levels. So they're essentially uninsured. That would make you nervous if you're a corporation or high net worth individual and you
And that's
have.
250,000 that
That's right.
you
So
get for
let's say you
insurance.
had a 10 exactly. So if you had a $10 million account, you're a corporation with a 10 million, $50 million account sitting at Silicon Valley Bank or some other bank, and you only get 250,000 of that insured, well, you've got a lot of exposure there. So if a bank has a lot of uninsured deposits, those are more likely to have flight risk, and so that's key to understand as well here as far as how quickly deposits can leave a bank.
Good
And
point.
so, yeah, but if you look at First Republic, First Republic shares a similar issue with Silicon Valley Bank, which is that their deposit base is heavily uninsured. So if you look at the total amount of deposits that are uninsured, it's about 2/3. So about 68% of FRC's total deposits are uninsured. So right off the bat, you're a little bit worried there because even though First Republic has very good customer services a very high net worth client base, that client base could be very worried that a lot of their deposits aren't insured. And so in a flight scenario, you could have a lot of those depositors moving out very quickly.
And
Uh,
in a higher interest rate environment, even more incentive to move money out into other types of accounts, basically.
That's
Uh,
right. You nailed
yeah.
it. You nailed it.
High yield
Another
savings accounts, treasuries, whatever.
Absolutely. You nailed it. Yep. Because if you think about it, if a bank has a lot of deposits that they're not paying high rates on, if they have a lot of deposits that are low interest bearing or non-interest bearing, that's another reason why your depositor base might move away from you. If you're not
Mhm.
paying the interest in a world where, short-term interest rates are 4 or 5%, then you're also
Cough
likely to
it
lose
up.
deposits.
You
That's
gotta cough
right.
it up these days.
That's right.
Yeah. So basically, they had of the 176, 119 billion were uninsured deposits, which is like a huge amount of
Yes.
their deposits. So that makes sense. And then this I found very interesting. If you want to maybe talk through how this might be a little bit different from Silicon Valley's situation.
That's right. Yeah. So on the depositor side, we do see a lot of similarities, but on the balance sheet, especially on the asset side of the balance sheet, we see some significant differences with First Republic and Silicon Valley Bank. So we saw that Silicon Valley Bank had a huge hold to maturity securities portfolio that put it at risk. If you look at FRC's balance sheet, they have a pretty small hold to maturity securities portfolio. It's only 13% of the bank's total assets. If you recall, the Silicon Valley Bank, it was almost 50% of their total assets were in hold to maturity securities. But
Right.
yes, in the case of FRC, though, pretty small, or much smaller compared to Silicon Valley Bank. Now, what they do have instead on the asset side of the balance sheet is a lot of loans. The loan book, these loans that are made to high net worth individuals and small businesses that they're earning interest on are almost 80% of the total assets. So instead of investing in government bonds and securities, they're investing in loans, which you could also say is relatively medium to long-term assets themselves. They're not super liquid. You're not going to be able to just go out and sell your loans tomorrow.
Which
But
is almost
again,
worse in a way,
yeah, yeah.
right? Yeah.
And when you've seen a lot of traditional bank failures in prior crises, let's say the savings and loan crisis of the late 80s, early 90s, what you saw were a lot of small banks failed because of this, because they had a lot of illiquid loans that went bad. And once those loans started going bad, they didn't have the liquidity to meet the depositor outflows. Once depositors figured out these banks had bad loans on their balance sheet, they started to leave, and that just created that self-reinforcing mechanism where the bank was trying to raise liquidity and they couldn't. Same thing happened in the GFC. A lot of banks, including some of the big banks, they had a lot of toxic assets on their balance sheet, assets that were being marked at values way higher than what they were worth. A lot of the loans were going bad, particularly in areas like subprime and some of the mortgage areas of the market, CDOs, et cetera. So they had a lot of bad assets. And so that was like the way that a lot of the global financial crisis banks failed.
So is this in is the essence of all of this just bad risk management or bad asset management and asset allocation? Like that's kind of my question. I don't you may not have an answer to that, but I'm curious your thoughts. Like what went wrong here? Like could this have been done better on the bank side and how they managed
Absolutely.
this?
Yeah, I certainly have my own opinions here, and people will probably differ in their opinions somewhat as well. But, a lot of people may blame the regulators or the Fed for hiking interest rates too quickly. I can understand why some blame might be put on the Fed for being behind the curve for a while and then having to catch up and hike rates too fast. I agree that there's some blame to be placed there. But these banks, this is their whole business, their whole job is to manage risk. And Silicon Valley Bank didn't have really any significant interest rate hedges. It's been over a year that rates have been slated to rise, so it's not like there was no
It's not like they
warning.
didn't know.
That's right. We were talking about on the We Talk Money podcast 2 years ago about the inflation problem and why we thought rates would have to rise, right?
Exactly. Yeah.
So these banks, it turns out as well, Silicon Valley Bank didn't have a chief risk officer for like 8 or 9 months last year, which is crazy. So there were some serious problems there with mismanagement. Now, I will say banks inherently are risky because they're leveraged. You know, they take in these short-term deposits and they lend them out or invest in security. So there's always going to be somewhat of a mismatch between the length of your the duration of your assets and the duration of your liabilities. Customer deposits are liabilities that could flow out the door in many cases quite quickly,
Right.
whereas your loans are typically going to be multi-year because you're going to want to earn higher rates. So
Right.
that mismatch almost always exists. Now, banks can manage for those risks by doing things like hedging or having sound risk management with who they loan to, and also obviously in Silicon Valley Bank's case, they just got too exposed to a very specific type of security. So things
Yeah.
like that, there are ways to manage. And FRC, I don't know, I haven't gone too deep into their loan book. I know they have loans in the mortgage sector. I know they have loans in the corporate sector. So there could be some risky pockets of loans there. I don't know. But as far as the market is concerned, it's worried because FRC has the ability for deposits to move quickly. So if there is any questions about the assets at FRC, if they do start to take losses, those deposits can move out really, really quickly. So that's the concern there. I do think the Fed programs, which we can talk about, that have put in place do help the situation a little bit.
Mm-hmm.
But fundamentally, these banks are still going to have to do the right things from a risk management perspective, and the ones we saw fail mostly did not.
So basically, people that the FDIC, which insures our bank deposits up to $250,000 per person per type of ownership on the account. And I just did a tweet storm about that. If anybody wants to read that, feel free. And I explain FDIC insurance a little bit more. But basically FDIC kicked in, they're taking over the bank, and now the Fed is basically saying, no, 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 don't worry. If you had more than what FDIC is going to cover, you will be made whole no matter if you had 5 million, 10 million or more. The Fed is basically kind of backstopping these banks and making sure that depositors are made whole no matter what, correct?
That's right. It's backstopping the failed bank's depositors. So it's not going out and saying every bank
The
out
Fed,
there. Yeah.
yeah, failed banks. Yeah, good clarification. Um, so that's a good thing. I know there's an argument over if this is a bailout or not, which I don't think is really in the scope of this conversation. Is probably not worth getting into in too much detail. Call it what you will, but basically, the Fed is stepping in. Do you think that this is the right move for them to do? It seems like it is,
I do.
especially with things a little rocky right now with the economy.
Yeah, I think if there's any time to step in, it's at that beginning of a banking crisis to try to stem the crisis from spreading. So I think it's a good move. It's important to remember that at a bank like Silicon Valley Bank, there's still a significant amount of assets that would be sold in a liquidation to try to pay off the depositors. Now, I was doing back of the envelope math, and I was assuming that even if the FDIC and the Fed hadn't come in to backstop the depositors, that the depositors were eventually going to get back 70 to 80 cents on the dollar at a minimum. And a lot of that depends on what the loan book would be sold for, because, the FDIC could come in, very quickly sell all the investment securities, which are pretty liquid. They're government securities, sell those, take the proceeds, pay off the depositors 50, 60, 70 cents on the dollar.
Mhm.
And then the rest of the asset side, the loan book would have to be sold probably to another bank. Who knows at what discount or at what level, but the depositors would eventually get some of that back as well. Now, there would be a timing issue. It probably could take months or quarters for that sale to actually occur. And so that's why there was a lot of uncertainty over the weekend. Well, what are depositors going to get back at Silicon Valley Bank? Are they going to have access to the money? Are they going to be able to make payroll? There's a lot of small businesses and startups involved here as depositors. So that was why I think it was a good idea for the Fed and the FDIC to come in and say, we'll make up the difference. We'll make sure that all your funds, all your deposits are there on Monday, and you can go about business as normal. That way, not only does it not spread to the banking system as a whole, and hopefully you
Mhm.
don't see a bunch of other regional banks, FRC and many others, go down with bank runs, but also you don't have a cascading effect on the economy with small businesses not having access to payroll, having to lay people off. That would be a significant economic hit as well. And so they don't want to see that either necessarily. So yeah, I would say that this was not a traditional bailout in the sense that we think about bailouts like we had in 2008, 2009, where the banks were recapitalized. The shareholders and debt holders were at least getting something back. They weren't taking zeros on their debt and equity. In this case, however, the shareholders and debt holders are not being bailed out. The shares and debt will likely be worth zero.
Yep.
It's the depositors who are being made whole. And again, they would have probably gotten somewhere between 70 to 90 cents on the dollar anyway, but we're making up that difference from the FDIC and the Fed.
So basically, the FDIC and the Fed are just really having to come in for kind of part of it, not all of it, because the bank does have assets that they can still sell to pay it back to the depositors.
That's
So
exactly right.
awesome. So I know a lot of people are probably thinking, should I pull the money out of my bank? Is my bank solvent? Is my bank going to be okay? Is my bank going to fail? Like, a lot of people are thinking this. So I wanted to kind of talk through, and maybe we can look at a balance sheet of Wells Fargo, because this is one of the majors. This is one of the major banks, right? And really what I wanted to get at here was, should people be concerned about their bank, and how do they know if they should be concerned? And like, maybe how do the big banks like the Wells Fargos, the JP Morgan and Chases, the Bank of America, how do they differ from some of these smaller regional banks?
Yeah, great question. Great question. Yeah, the large banks have been getting a lot of deposit inflows because they are seen as a bit more sound, a bit more diversified. They manage risk a bit better. We'll just take a look here quickly. If I scan over Wells Fargo's balance sheet, we're not doing an in-depth dive here, but just a couple things to note. The
Okay.
held to maturity security portfolio on the asset side, we saw that Silicon Valley Bank, almost half their assets were in those held to maturity securities where they had potential losses. Wells Fargo, they do have 297 billion. The value of the balance sheet securities are 297 billion. If you look at the fair value there on the left,
Not that far off.
yeah, 255. So potentially, they could be at risk of maybe 30, 35 billion, or I guess actually closer to 45 billion potential loss there if they had to force sell them today. Now, if you look at the bottom of the bank's balance sheet, total equity, Wells Fargo had about 181 billion. So they could completely absorb the loss of the held to maturity securities if they were forced to sell them today. So that's nice to see. Held to maturity securities not really a solvency risk for the entire entity as a whole. Looking over the balance sheet, other places, obviously loans is a big category. A lot of assets similar to what we saw with FRC. Wells Fargo doesn't have an HTM portfolio issue, but they do have a lot of loans, 955 billion of loans, which makes up about half of their total assets. And so, there's always questions about banks' loans in terms of their loan book. Are they going to see defaults on mortgages, credit cards, commercial real estate loans, et cetera? So far, we've seen most big banks' trends with loans be relatively contained in terms of losses. That can change in the future, but right now we're seeing relatively low loss rates, including for banks like Wells Fargo. Now, when we look on the liability side of the balance sheet, again, one thing we always want to be cognizant of or worried about is if the liabilities are significantly uninsured or significantly zero interest paying, in an environment where customers can take their deposits elsewhere. So Wells Fargo, it looks like, their non-interest bearing deposits here, 458 billion out of 1.38 trillion. So you only have about 33% that are not bearing interest currently. Silicon Valley Bank had like almost 50% of their deposits were not paying any interest. The other thing, of course, is insurance on the deposits I had looked up earlier. Wells Fargo's uninsured deposits make up about 37% of the total. So just over a third of deposits are uninsured or above the insurance levels. Silicon Valley Bank was at 90+%. There were, I think some said 97% of total deposit value were not were above the FDI insurance limit at Silicon Valley Bank. And I think in the annual report, it said something, I think I calculated somewhere around 90%. So let's call it 90% plus Silicon Valley Bank's deposits were uninsured. At Wells Fargo, that number is only 37%. So it's not nearly as concerning. The deposits don't look like as much of a flight risk, so to speak, at a place like Wells Fargo. So these are all good things, right? We don't have a hold to maturity securities portfolio that could blow a hole in the balance
Take all
sheet.
the equity away, basically. That's a big
Exactly.
difference I'm immediately seeing is, you look at the total equity compared to the loss in the held to maturity securities. We're not talking about zeroing out here like we were with Silicon Valley Bank. Am I reading that properly?
That's right. That's exactly right. Yep. So you don't have an immediate solvency question there because of the HTM portfolio. Your deposit base looks a little bit more stable. And also, you do have the loan book, but right now we've seen the loan losses be relatively contained among the big banks.
Yeah. And we'd want to look at, what does their loan book look like in terms of the maturities within the loans? Do they have a lot of loans that maybe kind of will be paid off sooner than others and kind of what
Hmm.
that looks like? But
That's right.
and I was looking at the held to maturity losses here. It looks like we were looking at about 14% losses in the held to maturities. I could do some, quick math here to see. I don't know if you know off the top of your head the percentage loss that they were
It's
looking at.
Yeah, it's a little higher. I think
It's a
it's
little
closer to
higher.
high teens percentage on the
17
SVB book. Yeah.
16.5%. So yeah, kind of similar in terms of what the losses look like for these held to maturity securities, but obviously Wells Fargo had less loss than Silicon Valley in that sense. But yeah, okay, so that definitely helps kind of clarify the big difference between the small banks and the big banks and how the larger banks are basically more well capitalized.
Yep.
They're more regulated. So, what do you say to somebody who is thinking, I should probably take my money, I don't trust the bank? What advice would you give somebody that's maybe thinking that? Because I know a lot of people probably are.
Yeah, well, I guess the question is always what's the alternative? Where would you be able to put your capital and what does that safety look like? It's all kind of a relative game in some senses. Is it safest at a JP Morgan or Wells Fargo, or is it safest, under your mattress where it could get stolen or burned up? Is it
Right.
safer in a Fidelity money market fund? Is it safer in a regional bank? And these questions don't have an easy answer typically, but I would say in the case of the big banks, you do have higher capital ratios because the regulators demand higher capital ratios at the bigger banks. They have more sophisticated hedging programs. They're a bit more diversified geographically and in their loan book generally. Even Wells Fargo, just looking at the cash line of the balance sheet, has a lot more liquid cash than some of the other regional banks. And so they're relatively safe. Now, again, it's still a bank. You're still putting your capital in an institution that is inherently leveraged. But I don't know that the regional banks are going to be safer than the big banks in most cases, and I don't know that money under the mattress is safer. It's safer in some ways and more risky in others. And
Mhm.
then you do have the FDI insurance capabilities. I know you've spent a lot of time looking at the different ways that you can segregate accounts and use different accounts to stay under FDIC limits, even if you have assets well.
Millions.
Exactly. Yeah.
Yeah. Yeah. Yeah, basically FDIC insurance works more so by ownership category. So like if you say you have a bank account and it's just at the same bank and say you have a single owned bank account. So Joe has a single owned bank account that's 250,000 right there, and then
Mm,
say they have in additional to that they have a joint ownership bank account with their partner. Well, they get an additional $250,000. So they get 500,000 just for them alone, and their partner gets a whole nother 250,000 for the joint. So yeah, definitely check that tweet out. There's an example that I popped in there from the FDIC directly, and it shows how ownership categories can help you diversify enough, even if you have millions of dollars in one single bank account, how you can achieve that by ownership category. So definitely something to think about. I think that even though the Fed is coming in and helping, I still think that optimizing for FDIC insured limits is a good thing to do, just in case, help you sleep better at night.
Absolutely.
Okay, so we covered a lot. I guess to kind of wrap things up, I think that a lot of people are probably feeling pretty anxious and pretty stressed about this, but to kind of piggyback on the things that you said, I agree. There really isn't a better alternative. Not only do we need to try to beat inflation and earn interest on our money and invest our money, right? So that's why maybe think about going to those bigger banks that might be better off in the end. And something that I was thinking about, Travis, was could we see a lot of consolidation in the industry now after not only to the 2008 financial crisis, but now this, where a lot of smaller banks kind of end up being bought or taken over by larger banks, and really we just end up with a smaller, a smaller number of banks overall in the US that are kind of too big to fail, and it just makes the money kind of safer in that way. Is
Yeah,
that something you see it possible to happen?
I certainly think that trend will continue. We've seen bank industry consolidation for the better part of the last 2 or 3 decades, and I think that's likely, unfortunately, to continue.
Mhm.
And whether that's a good thing or not depends on a lot of different factors in your viewpoints. But I do think, as consumers, as those who are trying to figure out how to navigate the situation, there's options to spread it around. And so I think, personally for me, it's a combination of accounts at larger banks. It's a accounts at some investment managers, accounts at money market funds, and ways to protect the different assets in different ways. And so, like, kind of looking at not just a single source, but multi-source, trying to diversify that risk away from your perspective, I think it can be really helpful. But yeah, unfortunately, on the banking side, we're probably headed for bigger banks, at least in the near term, and society eventually will figure out, hopefully, some new ways of doing banking. I think it's interesting to think about the idea that as depositors, as people who just want a safe place to put our money, we're having to put it in inherently leveraged institutions that are making all these decisions we can't control about what to do with our
Mhm.
funds. And
Mhm.
we've just accepted that as a society for so long. But I think in the future, we'll start to think about ways where we might be able to design institutions to handle those funds and to pay for those services in different ways so that they don't go do stupid things with them.
Yeah, yeah, that's actually a really good thought experiment of what that could look like in the future.
Hmm.
I agree with you. I have so many different accounts. Like, I have to keep a spreadsheet to keep it all straight, and I think that's okay. I think a lot of people want to keep everything in one place because most people just don't want to deal, and they just want to have one login, one place for everything, retirement accounts, high yield savings accounts, all of it. And the fact of the matter is, it's not a bad idea to diversify across different types of banks and different types of accounts. We both do that. I know a lot of wealthy people that do that. And I think that that's something to consider. And however you have to organize that in your head, you got to figure that out. But having everything in one place might not end up being it's not a bad thing to do, but you might be able to optimize it a little bit better and just be able to sleep better at night knowing that um you're not at the mercy of one institution, basically.
Yeah,
So
especially as your assets rise and you become wealthier over time, you have more to protect.
exactly. Well, this has been amazing. Thank you, Trav, for coming on. First of all, I want to tell everybody we are mentors in the Skill Incubator community. We do a stock market update every single Monday. You get
Hmm.
Travis's amazing insights and stock research. I'm in there as well, chatting about things that I'm looking at and doing in my own investment portfolio, different strategies. And you get access to us via our community chat. So definitely check that out. I'll link it. And also it's shetalksfinance.com/investor community. It'll be in the show notes. Trav, where can people find you? Where do you want
Yeah.
them to find you?
Well, there is a day coming where I'm going to resurrect my own YouTube channel. It is coming. I keep promising it, but it really is coming. But for now, the Stock Geek TV account on Twitter, I've been very active, especially during these market times. So certainly check me out on Twitter, StockGeekTV. I've also got a personal newsletter that I kicked off a few months back, and I've been pretty active in writing once or twice a week. And this, I think, is really aimed at your non-professional investors and trying to help people navigate the investment world. So they can find that travisdevitt.com, which is my personal site, or go to my other site, StockGeek.tv, and click on the newsletter link. But yeah, you can also look at my link tree there
There
in
it
my
is.
Twitter profile. So those would be the ones. And then also I have if you're really into stocks and investing, I do have the daily podcast. I guess I'm doing it a couple times a week, called Stocks and Coffee. And you can find that basically on Spotify, Apple Podcasts, or anywhere
Oh, there
else.
it is. Yep.
Yeah.
Right here. Stocks and Coffee podcast is the first on the link tree. And then this is the email newsletter, right?
That's right.
Awesome. And then you also have a link to the wealth building community if anybody wants to get in on some community action and invest alongside us. All right. Well, I think that covers everything. Thanks for being here, Trav. I'm going to have
Yeah,
you on
thank you.
again because I need your brain to help us, unpack all of these crazy things that happen in the markets.
Hey, it's always better doing this with friends and with partners, right? It's just much
Yeah.
better hunting for stock ideas and doing research with people that you know and trust, that you know are smart. So
Yeah, and Travis taught me everything that I know about analyzing balance sheets and income statements and all of
nah.
that. Oh yeah, you did. You did. I give you all the glory.
Okay.
Appreciate it, and I'll have you on again. Thanks for being here.
Thank
If you
you.
are not subscribed, everybody, please subscribe. If you liked this, hit the like button, smash the like button, whatever. Subscribe to Travis's YouTube as well. I'll link that in the show notes and get all of his goodies. And I'll see you next time.